Welcome back to another explainer. Today we are looking at an absolutely fascinating, undeniable shift in the financial landscape. The fintech industry is, well, it's officially growing up. We're talking about graduating from that scrappy, highly experimental phase straight into being a verified institutional powerhouse. Okay, let's dive into this. Do you remember when Trust Me Bro was basically the entire stablecoin industry's compliance department? Because that quote perfectly captures the massive pivot we're witnessing across the board today. We are finally, definitively leaving the Wild West era of financial technology. We're moving away from an ecosystem built purely on blind faith, and we're entering a totally new reality, one that is defined by massive audits, undeniable real-world adoption, and blue-chip acquisitions.
Here is our roadmap for today's explainer. 1. Tether shows its homework. 2. Figure goes full send. 3. Citi shops for tech. And 4. The future of finance.
Section 1. Tether shows its homework, converting trust us to assigned opinion.
So Tether just achieved a completely monumental milestone. They finally got a clean, unqualified audit from KPMG US for their 2025 financial statements. And this brilliantly illustrates the total contrast between the past and the present. For years, the main knock on Tether was their opacity. They just give us these random snapshots in time. But a full audit? That means KPMG dug through the entire balance sheet. And in a detail that sounds literally straight out of a heist movie, the auditors actually took a clipboard and physically counted every single individual gold bar Tether owns. They verified it themselves. No way around it.
Now, what's really interesting here is this massive number, $6.814 billion. After all that rigorous digging and physical counting, that is the exact amount by which Tether's reserves actually exceed its liabilities. KPMG gave them an unqualified opinion, which, if you're not an accountant, is the absolute cleanest grade an auditor can give a company.
Honestly, it's kind of like the kid who skipped every single study session, showing up and acing the final exam anyway. Sure, this Big Four audit doesn't just magically erase Tether's long history of opacity since they were founded back in 2014 under CEO Paulo Arduino. But, the grade is the grade. And for the 650 million daily users of USDT out there, it undeniably sets a brand new standard for every single stablecoin issuer that follows in their footsteps.
Section 2. Figure goes full send. Blockchain lending originates billions. While Tether was getting graded, Figure Technology Solutions was out there putting up massive revenue numbers that frankly look like a typo. Get this, Q2 revenue more than doubled. It jumped 113% year over year to $226 million. And their net income? It nearly tripled, hitting $87 million.
Breaking down that growth even further, we hit $4.3 billion. That massive number represents a 132% jump in their consumer loan marketplace volume. And specifically, Figure Connect, which is the marketplace piece of their puzzle, handled $2.8 billion of that volume entirely on its own.
This right here is what you'd call the beats and rips version of earnings season. Usually in fintech, we're covering the beats but bleeds stories. The ones filled with caveats and asterisks. But not here. This is pure growth that is actually growing. CEO Michael Tannenbaum reported that weekly loan applications topped $1 billion in July alone. So yeah, it's really no wonder the stock saw a massive two-day pop right after, basically taking a two-day victory lap on the markets.
So how exactly are they executing this? Well, co-founder Mike Cagney's platform connects loan originators, like your banks and fintechs, directly with capital providers using blockchain infrastructure. They're literally rebuilding lending on completely different rails, kind of like what Nubank did for banking. They now boast 489 total origination partners, and they just added 102 new ones in this past quarter alone. Plus, their pending acquisition of real estate lender Kiavi is right on track to close in the second half of 2026, which is going to push them into entirely new adjacent markets. Figure is absolutely proving that blockchain lending is no longer just a thought experiment. It's a rapidly compounding business.
Let's move to and see how this builds into Section 3. Citi shops for rewards tech, the establishment buys in.
So how exactly does the traditional establishment buy into this new era? Well, Citi's U.S. consumer cards unit just made a major strategic acquisition to better serve its roughly 70 million card members. They are bringing in a company called Card Financial. Basically, it's a modern rewards tech startup that builds AI-driven, merchant-funded loyalty programs. And Citi's strategy here is incredibly clear. They want to fold this platform directly into their massive existing card business.
This brings us right to the classic buy versus build dilemma that every big legacy bank eventually has to answer. Look,
Building a modern, merchant-funded rewards engine completely in-house takes years. It requires a vast amount of engineering talent that these legacy banks simply do not always have just lying around. So, by choosing to buy, Citi is essentially trading for a proven star player instead of grinding through the farm system for years, just hoping to develop one from scratch.
And this really highlights a much larger industry-wide pattern. Fintech M&A is absolutely a core strategy now. It's not just some side project anymore. Legacy banks are finally waking up to the fact that consumer loyalty expectations have been entirely reset by seamless digital apps, not physical branch locations. Citi literally just bought its way past years of build time in the rewards arms race rather than risking getting out-innovated by their own cardholders' expectations.
Finally, Section 4, the future of finance. Fintech's experimental phase is over.
If there's one overarching theme to take away from all this, it's that Fintech's experimental phase is officially 100% over. So the crucial point is summarized perfectly by these three solid pillars, proving this industry is growing up fast. First, Tether secures the stablecoin foundation with an unqualified Big Four audit. Second, Figure proves that blockchain lending originates billions in actual volume. And third, a legacy titan like Citi buys modern rewards tech to instantly level up instead of building from scratch.
The receipts are printed, the technology is scaling vertically, and the establishment is buying in big time. Which leaves us with this final, really provocative thought to consider. Now that fintech has definitively entered the mainstream and the whole Wild West era is over, who are going to be the real winners of this new era? Is it going to be the agile tech innovators, or is it the legacy giants with the incredibly deep pockets? It is going to be a fascinating space to watch, and we'll be right here to explain it all as it unfolds. Thanks for exploring this with us.